Hey everybody, back with another ETF review, and today we're going to be looking at XRMI, or the S&P 500 Risk Managed Income ETF from Global X. Want to take a look at this because if any of you have been in the Discord or have followed me for a little while, you know how much that I have been talking about NUSI, which is the Nationwide Risk Managed Income ETF, and my only gripe about that is that it follows the NASDAQ as opposed to the S&P, and I do like the extra diversification that comes with the S&P 500, which we have here. One thing to note before we go into this fund is that it is extremely new. It'll turn 4 months old on Christmas Day, so note that we have very little data to go on here. We're going to be making a lot of assumptions going forward, assuming that the past will reflect the future, which of course is not always the case, so just keep that in mind. Without further ado, let's get into it. As always, we'll start by looking at the expense ratio, currently sitting at 0.6%. This is an actively managed fund because it does write options. Therefore, you aren't going to be getting one of those ultra low cost passive funds here. But 0.6%, anything around 0.5%, is about run-of-the-mill average for your actively managed funds, so nothing too crazy. Just note that for every $10,000 you have invested, you're going to be spending about $60 a year in fees. Now, what exactly does the fund do? As the name suggests, it is looking to provide income that has a little bit of risk aversion. How does it do that? It writes an options employs an options collar strategy by writing covered calls on the S&P 500 components and buying 5% out of the money put options. What that means essentially is it's going to buy all of the underlying stocks in the S&P 500, write covered calls that are at the money while buying out of the money put options to cap your downside risk. Note that because it's capping downside risk with the puts, it's also going to be capping the upside risk with the covered calls. This is going to make it trade in a very narrow band if things go correctly. As we can see from its performance over its 4 months of existence, it is traded between $26.34 and $26.95, about a 60-cent range over that entire 4 months when the market has been very volatile is very nice. But again, that is just 4 months of data, so we can't read too much into that. But so far in its short life, it's doing what it's supposed to do, reducing market volatility. When there are huge drawdowns in the market, although our drawdowns haven't been that big, only about 5%, it has been able to stave off any kind of thing like that. Looking back at it, another thing to note is how small it is currently. Being so new, it's only $11.5 million in net assets. There are funds out there that are billions of dollars. A lot of covered call ETFs are well over $1 billion, things like QYLD and others of that nature. So just note it is very small, which leads to a very low volume. As you can see, average volume sitting currently at less than 11,500 shares. So getting shares at the price you want might be a little tough. Just keep that in mind if you're thinking about this fund. Next, let's take a peek at the yield. As we can see, we've only had 3 distributions, so we do have to kind of extrapolate here. We can add these up to 59 cents, then multiply that by 4 for 4 quarters worth, and if we divide that by the current price, we're looking at about an 8.8% yield, which isn't too bad. That is paying more than something like NUSI, but paying less than something like QYLD. A thing to note is that this does have, since it has such a narrower band, you're probably not going to get as much capital appreciation as something like NUSI. So just keep that in mind. This does seem to be very much a strictly yield-oriented thing, whereas something like NUSI does have a little bit of capital appreciation to it over its short life. Next, let's actually take a look at the holdings. We can see that it does hold all of the companies in the S&P 500, down to some only holding a couple of shares, while it does hold the big boys at, almost $500,000 worth of its total net asset value. This is nice because if we can see that, as we see, they also have one on the NASDAQ 100, very similar to NUSI, which has its net assets being much more of each individual stock. For example, Apple sitting at 12% here, while in the S&P it's less than 7%. So a good bit of diversification does help you out in case there is any kind of market drawdown. You won't be hurt as badly, one would hope. Another nice thing about this fund and about Global X in general is that they keep their tax tax supplemental information very easily accessible, which if you're someone like me and your taxes get extremely complicated, this is very helpful. It breaks down the distributions by what kind of income that distribution is made up of, whereas we can see here, for example, investment income, capital gains, return of capital. If you are someone like me who has very complicated taxes, this is very helpful if your broker makes mistakes, because you can fix them yourself. You can go back in and see and double check things, whereas a lot of funds like NUSI, when you look through their supplemental information, it is extremely hard to find. I've still not been able to find it even when I've looked through it, so just something very nice to note about it. And they do it for pretty much all of their funds, which is a nice thing from Global X. Kind of shilling there, but don't worry, they don't pay me. So who is this fund for? Who should be looking for it? From the appreciation side, there's nothing here. If you're a dividend appreciation investor, you're not going to get anything here. The distributions are going to vary wildly based on the covered call premiums. If the market is particularly volatile, those premiums are going to go up. If the market is not very volatile, those premiums are going to go down. On the income side, this is definitely something to look at. 8 to 9% yield is nothing to turn your nose up at. It's especially good if you do like the covered call ETFs, for example, QYLD, XYLD, RYLD, which are also from Global X, but you do want some downside protection. Barring something very strange happening, this is safer than for example, XYLD, and QRMI will be, here we go, and QRMI will be safer than QYLD just because of those protective puts. Now, a thing to note about those protective puts is that they are just for market sell-offs. If there are just small, like 1, 2, 3% changes, really single-digit changes in general, you're probably still going to lose the same amount there. However, if there is something crazy like what happened in 2020 where the markets lost 20, 30% of their value in a month, this should be able to cap your losses because of those protective puts, as we saw with how NUSI performed, losing only about 10% versus the NASDAQ losing 30%. This should do something about the same, whereas if the markets fall by 50%, maybe you're only losing somewhere like 15 to 25% because of those protective puts, depending on where exactly those puts are at. So if you're looking for income but you also need some downside protection, this definitely might be something to look at. Another thing to keep in mind is that over the long term, this is very likely, very likely, almost guaranteed to underperform the market. If you're looking for growth in any way, this really isn't going to do it for you, just because the fact that if those covered calls hit, because the market is growing, it's going to have to sell off the assets and then rebuy them at that higher price eventually, and then sell the new covered call, which is going to lower your total returns over time. If the market goes up, this will appreciate in value simply because of the way that appreciation works. However, that appreciation is going to be heavily capped by those covered calls. So keep that in mind. If you're really looking for appreciation that happens to have income, this isn't something for you. This is a purely income play, as of course the name suggests, so just keep that in mind. Going forward, I'm going to be following this fund pretty closely. I will say that I have a few shares, not very much, not even $1,000 worth of it at the moment, but I am definitely looking at it as a way to provide income with a little bit of downside protection for myself. I would tell you, just look into it more. I definitely haven't read everything I should or can about it yet. I will be doing so over the future, and I might be doing a bit of an update, and I would suggest that if you are looking at it, to do the same. And as always, I hope this helps, and thanks for watching.